Great, thank you, Ann. So we're at the final session of the day. I know that means we need to operate with speed. So we will be efficient here. But up to this point, we've had a lively discussion about every flavor of energy and the thirst for more of it at, again, speed, scale, reliability, and affordability. And of course, I've also heard expressed several times a strong desire for supportive policy in order to make that happen. So how are we going to pay for it? And this panel will be broken down basically into two parts, what we're trying to finance and how we're going to do it. So I'm joined by a great group of folks here that are well positioned in the energy sector to share their perspectives on financing the global energy transition. So I'd like to start with an intro from each of them, and we'll just work from my left here down the row, please.
I appreciate being here. Chris Paulsen, VP of Business Development for Pioneer Natural Resources. My role at Pioneer includes both conventional M&A work in the oil and gas side, but also our energy strategy, clean energy development, commodity outlook, scenario planning, and so forth. I'll tell you, if I knew that Robert Bryce, Bob McNally, and the host of other panelists we had were here today, I might not have agreed to participate as the last one between the networking session. It is good to be here. I've been part of sustainability conferences here recently, renewable conferences, and so forth. It's good to hear panelists like Dr. Mackenzie or Robert Bryce, and the balance that has been brought to the discussion today, and I look forward to continuing to participate, albeit a Baylor Bear at a TCU conference.
You can take pills for that.
National championship pills, I might add. But,
that was good. Okay, I'm Tom Bates. I have been part of the Energy MBA program here for the last 12 years. Well, I've been teaching energy macroeconomics for the last 12 years. I maintain an active role in the energy business. I'm on 3 public company boards right now. Before that, I spent 10 years in private equity. We raised 5 funds and $3 billion, which we invested over that 10-year period of time. And then prior to that, I spent 25 years in industry with companies like Schlumberger and Shell. I was fortunate enough to spend 5 years in Europe and 2 years in Asia. And over the course of my career, I've been to about 85 different countries. One thing I do want to say is that I have affiliations with a number of different companies. My remarks today are my own, and they don't necessarily represent those companies with whom I have affiliations.
Okay. My name is Robert Clarke. I'm a longtime researcher with a company called Mackenzie. I've basically done shale my entire 17 years at Mac, both domestically and abroad. And I was introduced to TCU about 6 years ago by Ed. Thank you, Ed. Gave a couple of guest lectures, and the students warmed to it. And I teach a class here now 8 weeks every fall in the Energy MBA program. So thank you, Ann, for that opportunity. If it's okay, Megan, I may use my intro minute to make a few observations from the other panels of the day. Is that okay?
Run with it.
Okay, because I just jotted them down. I wish Bob was still here. I think I might challenge some of his oil supply numbers, and I'm just throwing these comments out there. Right? I would definitely say watch oil supply over the next 7 to 8 years, particularly watch the U.S. in 23 and 24, when debt levels are where they need to be, when we sort out some of these supply chain kinks. Tight oil can do a lot at $100 a barrel, so I would just caution people to watch that, and also pay attention to Latin America, all the great stuff that's going on down there that was mentioned a little bit. Watch that over the next 3 or 4 years as well. So that will be one comment on oil supply. There was some other comments throughout the day about the industry isn't investing enough, and I don't have the slides with me, but I've been talking quite a bit about this the past few months, about a big study Woodmac did, and the real Cliff Notes version is, think how far $1 gets you in shale now versus a decade ago, right? That same phenomenon has happened globally in upstream. So this idea that just because we're investing less than we did 7 or 8 years ago, doesn't mean that there's not a strong production response that could come from that investment. So I would just caution people a little bit with the "we're chronically underinvesting" rhetoric. And can I keep going, or do we need to? I'll stop.
Yeah,
Over to you.
you're going
I'll
to
stop.
steal your own thunder because you get the first question. But, the capital efficiency inflection in the United States has benefited shale producers. Still, we've seen persistent underinvestment in global energy and a push to switch from this to that, which would be traditional energy sources to renewables, where it's early innings in terms of delivering reliable, affordable, and scalable energy. Meanwhile, on the demand side, we've seen the thirst for energy to increase to pre-COVID levels. So, Rob, turning to you, can you walk us through your outlook for the supply mix over the next decade and how fossil fuel investment and supply will evolve over that time frame?
Yep, I will. And what I will say, though, before I mention the numbers is there's this interesting issue that I think every panel has sort of tiptoed around, but not necessarily brought together, that when you talk about what's going to change the energy mix, it comes down to customers, right? And ultimately what people want, right? What energy consumers want. It comes down to capital markets, which is what we're going to talk about on this panel, which we haven't talked about much today. It comes down to technology as well, which we talked a little bit about on the prior panel. And if you put your shell hat on, which I do all the time because that's my background, and you think about what capital markets are going to support, what technology could enable, that's when you have the setup for this sort of J-curve change. And I would just introduce that because some of the numbers I'm going to share, these are Wood Mac numbers, point to a pretty steep growth in some of these green energies over the next couple of decades. So I might go a little bit further than 10 years, Megan, so I'm going to share some numbers kind of between now and 2050. Primary energy demand, there were some points made throughout the day that hydrocarbons are going to be around for a long time. That's absolutely true. We agree with that. There is a bit of a plateau effect maybe over the next decade or so. You have some changes going on with the petchem industry pulling on oil more than the transport sector does. But if you go out to 2050, hydrocarbons are about 70% of total energy mix. So still a big number, and that's a long way in the future. So I just wanted to get that point out there. Wind and solar will grow a lot, right? A lot of that is policy. A lot of that is technology. We go from sort of mid-teens now to maybe upwards of 50% of global power output mid-century, right? I know sometimes those numbers are tough to wrap your head around in Texas, right? But encourage folks to look at what's going on in Europe, look at what's going on globally. Huge policy pushes. So wind and solar are going to scale regionally. Asia has been the story for the past decade in terms of energy demand. It will continue to be the geography to watch. In terms of what types of specific demand, electricity is the one, right? So I'm glancing at a chart now that shows total consumption by fuel, oil kind of plateauing, gas continues to grow, but electricity is just linear and it's up and to the right, right? So one other way to think about energy transition is maybe just, it's a big call on electrifying the economy, and technology-driven renewables gives us another tool in the toolkit to do that. So.
Yeah, that's great color. Tom, help us put that into context of the energy transition. Are we traveling along the path to a successful and just energy transition, our path to net zero?
We are on an energy transition. I'm not sure we're on a path to net zero, at least not anytime soon. I think there are things that we all want, right? We all want reliable energy supplies. We all want low-cost energy, and we all want a good environment or minimum climate change. But there's a big difference between what we want and what we need and what we're willing to pay for. And what we're willing to pay for is going to determine what the trajectory is to net zero. And to quote the former Energy Secretary under Obama, Ernie Moniz, he said in a March 15th interview, if we want to plan like everybody goes to net zero in 2050, I have no idea what we're talking about. It's just not going to happen. And at the same time, we have people like the UN Secretary General saying 3 billion people are in imminent danger from climate change. Now, I don't know what imminent danger means to him, but to me, it means there's somebody at the front door with a gun. And I don't see 3 billion. So there's a lot of rhetoric that's being bandied about that, we just need to make sure that advocacy isn't impugned, that hasn't impugned our objectivity. And so I think the path, we're still on the right, we're on a path. It's not the 2050 net zero path. And in terms of where we're going, I appreciated what John said in the last panel. In terms of technology, hope is not a strategy. We don't have the technology we need to get to net zero right now. I mean, I can tell you right now that if you look at what happened in the UK and Europe this fall, they have 32% renewables in Europe, 30% in the UK, and when the wind didn't blow, that market became unstable. Natural gas, which was the only fuel available to try to make up the difference, couldn't make it up because there wasn't enough available, and the price of natural gas went up on average more than a factor of 6 during that period of time, long before the Ukraine. And in some cases, it went up by a factor of 15. So I think we're at the point, at tipping point in many of our infrastructures where we're not going to be able to deliver power reliably, and that's going to make people mad. In the UK, Ofgem just increased the average price of gas and the average price of power by 54%. You think the yellow vests were unhappy when their fuel tax went up a little bit? How unhappy do you think the UK public is when their bill went up by 54%? So I think we just have to be rational about what the real path is and what technology is needed and when it's going to be available. And I'll stop talking in a minute. But I think we need a Manhattan Project for the technologies that we need to get to net zero, because what we have isn't cost effective. It takes, it's $30 a megawatt hour to generate electricity with solar or wind, but it's $150 a megawatt hour to store it. And that just makes it completely uneconomic. So whatever we come to, whatever solution we come to has to be technically sound and economically viable. We're not there for 2050 net zero.
Thanks, Tom. U.S. shale has accounted for the preponderance of global oil growth. And since September 2020, when Kimmeridge put out a white paper about the energy industry setting net zero targets, we have now more than a dozen shale companies with net zero targets in between 2020 and 2050, so some of which are net zero today. So if we think through that, Chris, can you walk us through Pioneer's approach to reducing Scope 1 and Scope 2 operational emissions, and how shale oil, the repeatability, the scalability, the deliverability of it, how it can play a pretty vital role in the energy transition as we reduce the carbon footprint and intensity of shale?
Absolutely. So, as we think about our Scope 1 and 2 ambition, which is a 2050 net zero ambition, really the ways in which we're approaching that today is most simply moving many of our Scope 1 emissions to Scope 2, and then coming alongside that, I think, a longer term in terms of renewable energy credits and other items to help us out and to offset our Scope 2 emissions. So when we talk about just normal, everyday operational efforts that we're undertaking to minimize and reduce, first off, reduce our Scope 1 emissions, and then 2, push them to Scope 2. I mean, when we talk about reducing Scope 1, what's been kind of common business practice for a long time at Pioneer are things like installing VRUs to tank horizontal tank batteries, not producing a battery without having a well connection there. Doing routine aerial flyovers. So we've increased the frequency of those aerial flyovers with Bridger this year. We'll do 3 this year. So not only will we kind of know the leak distribution, but also the leak frequency associated with that. Having MAC curves as it relates to potential Scope 1 offsets and different strategies that we can deploy in terms of pneumatics, or even deploying hybrid F-150s or electric F-150s in the field. So which ones are the biggest bang for their buck? And then when we talk about moving more things to the electricity side of the equation, our compressors, our 1,500 horsepower compressors, today we have, say, plus or minus 200 of those, and most of those are natural gas. All of them have been natural gas fired compressors up to this year. And so our purchasing habits are changing, buying electric compressors. With each one of those 1,500 horsepower compressors, there's 1 megawatt of usage associated with that. We're moving our drilling rigs to kind of a plug and play electricity standard there in many instances where we can. We have probably 3,500 miles of Pioneer-owned electricity grid. Now with that presents a lot of opportunities, but a lot of challenges in working with Encore to make sure that even our behind-the-meter grid, if you will, is stable and conducive to supporting a drilling rig that runs at 3 megawatts of usage versus a frac fleet that runs at 25 megawatts. There's not a lot of places that you can deploy a frac fleet on our own grid. And when you talk about today, we utilize around 150 megawatts annually of electricity. If you put a couple of frac fleets out there, the 6 or so we have running today, that doubles our electricity needs. So those are some of the things that we're looking at, trying to decide where we can consistently roll out, drilling rigs and maybe in turn some frac fleets. We are making e-fleet decisions on some frac fleets. Those are run with natural gas turbines largely today, but hopefully can move some of those to the grid at a point in time. So those are some of the strategies. And again, we come alongside on the renewable front, or plan to in the future. I would expect that we'll scale in a few renewable PPAs a year. I would love to prioritize behind the meter. We can accomplish that to some degree, but to do it at scale, you have to have some special circumstances for behind the meter at scale.
Tom, going back to you, about a week ago today, the SEC delivered its 510-page proposed rules on climate-related disclosures, and it broadly aligned with the TCFD and governance in particular. So, Chris just did a great overview of the strategy that U.S. shale producers, and a leader in the business, of course, is Pioneer, the strategy that they're undertaking to reduce their operational emissions. At the board level, how do you think about preparing companies for the energy transition?
Well, I think there are a few roles that the board needs to play. At the end of the day, management plays an important role, but from the board's perspective, it's getting the strategy right. So it starts with strategy, then it starts with capital allocation. Where do you get the capital? Do you need more capital to execute the strategy? Where does it come from? But the thing that I really want to talk about, which I think is frankly the most important, is the human capital, because we're going to need different human capital to walk down that road. And I can tell you right now, in the companies that I work with, we need more AI. We just need people that can handle big data and use AI to make decisions, even in real time. The smartest people in AI go into the gaming industry. We need them in the energy industry. And so I think the human capital issue is probably the most important and the trickiest challenge that we in the conventional energy industry need to navigate to successfully attack the transition.
So let's shift gears to how we're going to pay for it all. public upstream companies are holding the line on capital discipline. It's been underscored by Tom's point, careful capital allocation, and they find themselves awash in excess cash. The lion's share of that excess cash will go back to shareholders in the forms of dividends and buybacks and reinforcing balance sheets, but there's still residual cash remaining after making and meeting those commitments. So, Rob, from your seat, do you think we'll see public E&Ps and oilfield service companies invest in low-carbon ventures like we've seen from BP, Exxon, Shell, and Total?
Absolutely. I think different scales and different speeds. I'll break down OFS real quick and then E&P, but before my mind switches to that, Tom, you mentioned a little bit about shareholders, and I think your comment about like a Manhattan-style project, one way that I think about that is maybe that's happening underneath the surface, right? Maybe that's happening already with capital allocation. So if you're not familiar with something called the Net Zero Asset Managers Initiative, I encourage folks to look into that. It's part of another group called the Glasgow Financial Alliance. But to give you a scale of the amount of capital that these groups are influencing, it's about $130 trillion with a T, $130 trillion under management. And everyone that's part of that group has basically said, you know, we need our investments to align with some initiatives that move us towards lower emissions. And it's a 50% drop in emissions by 2030, and it's stretching to get to 100% by 2050, Tom. So it's a big stretch target. But this is a huge amount of capital where the investors are saying, if you're aligned with this view, we're in, and if you're not, we're not. Right? And for perspective, I think last year I did a quick search. Global GDP was 95 trillion. We're talking about 130. So the capital is driving a lot of this change, and it goes back to my point about customers and societal pressures and government policies and how all those things are aligned. But that does relate to sort of a funding mechanism, and directly to your question, Megan, you know, are there going to be more investments? I think from OFS, they'd like to, right? But they're not in the financial position that E&Ps are in now. OFS is still really hurting, is the brief way to put it. They're not dealing with a cash windfall like producers are now. I've got some numbers on percentage of fleet that's E-frac. I won't bore everyone with the numbers, but just understand it's a very, very small proportion now. I think what OFS is probably looking at are how they can add to the quality of discussion around CCS and CCUS and Schlumberger, for example, their understanding of reservoirs. I think there's a lot that will change there. The upstream players, though, what a fantastic position they're in, right? Record amount of cash flow, and I mean record amount of cash flow because, and I'm simplifying this, because spending is pulled back, cash flow now is stronger than it's ever been, stronger than it was, you know, going into the crash of 2008, 2009, right? So they can afford to invest, they can afford to try, and that's exactly what's happening. So I've got a short list of examples, which I'll just run through really quick, but hopefully this list approach lets you know who's getting after it and that there's different ways to put money into transition investment. So Continental and Talos are both looking at CCUS, right? In basins where they have a lot of subsurface understanding already, right? EOG is running a lot of compressors in the Permian off of solar. They've got a great incentive system going on with the state of New Mexico. Oxy is really pushing on the gas, right? We talked about direct air capture a little bit. They've got some big goals, but the end game for that is to produce a net zero barrel. Pretty remarkable concept. We'll see if they get there, all right? I think a lot of people are skeptical, fair. I think some investors are skeptical around the CapEx requirement, absolutely fair. But it's direct air capture to CO2 to do EOR in the Permian, like a net zero barrel, right? That's moving forward. Within the majors, there is a bit of a gap between the Euro majors and the US majors, right? The US majors are looking at, again, Exxon, CCUS. Chevron's looking at lubricants, right? Non-petroleum lubricants. The Euro majors are fascinating, though, and I appreciate we've got Dave and Total in the room. The strategies that these firms have and the pace at which they're going to change is just remarkable. So Total, I encourage folks to go and look at this. Kind of not too long ago, a couple of weeks ago, they came out with a new sort of roadmap, vision for 2050. So a production split, I'm reading here, 50% renewable power, 25% decarbonized molecules, biofuels, biogas, hydrogen, kind of like Chevron, and 25% oil and gas, right? Completely redesigning the portfolio. And within oil and gas, oil's down, LNG has a bit of growth. So big changes going on. I'm probably talking too much, Megan, but because of high prices, it's this wonderful setup where they can afford to make changes.
Yeah, there's a lot to unpack there, but my
Yeah.
favorite thing you said was a net zero barrel, because that could be pretty powerful as we think about the energy transition, the arc that we're on, and the ability for something that's already available, again, at speed and scale, to deliver on the long arc that is reducing our carbon footprint.
Yeah.
Just for some context, Baylor, TCU, and then Pioneer, and one of your closest competitors, Concho. So this next question is going to be really hard for me to get out and keep a straight face and be nice. But Chris, we would benefit.
Here,
I know.
So this is good.
We would benefit from hearing your perspective on this. Pioneer has a robust cash flow outlook and a very robust capital return program. So how does Pioneer think about investing in alternatives or renewables?
Yeah, great question, and just touching on some of Robert's comments as well in light of this question. I think that investors today are calling for us to find ways to invite more people back into the game. As Kimmeridge wrote in a white paper several years back, we needed to find ways to return cash to shareholders and give shareholders confidence that this boom bust cycle would not return and that growth at all costs would not return. And so despite the fact that I think we are generating a lot of cash, I think, from our standpoint, Pioneer standpoint, that cash needs to be returned in the form of meaningful dividends to shareholders to maintain interest in our industry. I mean, we've lost and potentially lost permanently for other reasons, significant shareholder bases, whether it be Norges Bank, whether it be New York Teachers or New York Retirement System and others, and we can get into that later. But we need to show that we're serious about returning our 100% plus individual well IRR numbers and have that translate in terms of return on capital employed and have it translate in terms of dividends. So I think that's a big part of it. So then that begs the question, how do you attack energy transition, and do you? And I think it's a struggle for somebody in my chair. If you look at some of the European integrateds that were discussed, they've been some of the poorer performing stocks in light of their energy transition. So when you talk about their capital that has gone towards the energy transition, it's not benefited their shareholders to date. Not to say that it won't in the future. And some of those have been very progressive in terms of their transition investment approaches. E&I has been very progressive, for instance. BP has outlaid a very progressive. Shell's been very progressive, and yet at the same time has been attacked by shareholders asking them to break up companies into two. When you look at Oxy this last week, they laid out a very interesting case, a 60-plus page presentation on low carbon ventures. Ultimately, that is going to have to be financed outside the typical Oxy regime. They said as much. They said that the capital's not there today, the returns are not there today. They're going to have equity co-invest, and people are going to have to believe in an appointed carbon price to make it work. So that presents real challenges when things are on the balance sheet and when they're part of your current entity and when you're having great rates of return on your core business. So you have to find ways in which your core competencies translate in terms of energy transition. And so we're taking that slowly. I think we're being pretty pragmatic about it. As we said, we're helping to come alongside in terms of our scope 1 and 2 emissions, in terms of renewable efforts, and that very clearly is related towards, doing power purchase agreements and facilitating renewables on our own surface. Okay, not investing alongside. We do invest in a few private equity firms on the energy transition front, relatively small investments. So when you talk about, $3.5 billion round number capital budget, it's very small by comparison. We're doing that because we want to accelerate our knowledge across various spaces and try to align those core competencies with some spaces that might make sense. But, we sit on the investment advisory board for one of those particular companies. And I think it has helped accelerate our knowledge, and it helps us understand what's working, what's not, what's in a 10-year investment horizon, and what's not. That's the beauty of some of these private equity funds. Many of them are going to have a very difficult time touching hydrogen. To that extent, CCUS will be a challenge. Special circumstances like Continentals was, where North Dakota has very strong primacy in terms of CCUS or carbon sequestration, and they had an ethanol-based mid-continent approach across multiple states. Those things are special. Those are rare. And then the CCUS Gulf Coast exercises are very expensive, and the returns are still yet to be known. So we're not aggressively pursuing relative to some of the major oil companies, but we're also not burying our head in the sand, and want to make sure that we're doing it the right way for our shareholders.
Sand in West Texas is too expensive to do that right now.
and availability as well, right?
That's a good segue, though, to Tom on private equity. Can you walk us through how private equity firms are thinking about investing in the energy transition, how they size up the risk-return opportunity?
Goldman just published an interesting piece on the returns, unlevered returns for projects. And offshore oil returns 22% on an unlevered basis. Wind and solar return less than 4% on an unlevered basis. So with my private equity hat on, I'm not going to invest in infrastructure projects in wind and solar that pay less than 4%. Now, are there opportunities to invest? And I mean, one of the reasons for that is that just in general, low carbon energy is 2 to 3 times more capital intensive than conventional hydrocarbons. And that creates a real burden because capital is expensive. SPACs are, potentially viable sources of capital. And I think somebody earlier this morning mentioned LanzaTech, which has announced a merger with a SPAC, hasn't closed yet. There are government loans available. EOS, which is a battery company, has applied for a loan. This is public domain. They're thinking they might get 25-year terms at T-bill rates. 25-year terms at T-bill rates, maybe even a 4% project could make sense. The Gates Foundation is in a couple of nuclear ventures, one of which, in terms of Manhattan Project, I know the Manhattan Project was a nuclear project, but I think we need another Manhattan Project for fusion. Fusion is, as Ernie Moniz said in his March 15th interview, fusion is a game changer. And the high temperature superconducting battery test that was successful, even if it was only 13 milliseconds long, that means that nuclear fusion, instead of being 20 years away, as it has been for the last 40 years, might be 10 years away, or it might be 15 years away. And that completely moves us into a carbon-free world. And we should spend as much money as we can on nuclear fusion.
moving from, you helped us address SPACs with that answer too, but how are we thinking, any one of you can reply to this, but the green bond or sustainability-linked bond market, you see banks linking covenants and rates to certain ESG KPI. Is this a good source of financing? Bloomberg estimates the bond issuance this year and this sorts of financial instruments will be bigger than $1 trillion. So I'm curious for each of you how you think about that as a viable mechanism for funding the transition.
I was just going to make a comment very much related to that around cost of capital, and I'd love to see the report you mentioned, Tom, because that's quite the spread, 22 to 4%, I think. The numbers that I'm myself a little bit more comfortable with is probably high single digits for renewable projects, and we'll call it mid-teens for global deep water. But point taken, there's a spread there. An interesting consideration for that, because there's so much capital wanting to move and align with policy and consumer preferences, capital wanting to move into green energies, is that there's a cost of capital arbitrage, right? So these are just round numbers, right? So what if my cost of capital, because a lot of people don't want to touch fossil fuels now, what if my cost of capital is 8 or 9%? And I hit a home run with a project, right? So what's my spread there? 500 basis points, right? Well, cost of capital is so cheap in renewables that maybe you don't need an elevated return to cover that, Tom. So, that's something that I know a lot of CEOs are starting to talk about openly. A lot of big bankers are starting to discuss as well, and quite frankly have been for a while. There are other tools as well. We're starting to see this with some of the renewable players, maybe take on a bit more merchant pricing risk because they do have concerns around those low returns. So there's a lot of moving pieces, I guess, is the only thing that I would comment around that, Megan, that it's one energy source being in the penalty box and one not has big impacts on how they're funded. Right?
One thought on that, and this is just off the top of my head. As it relates to capital structure, I think for fossil fuel firms long term, the question is, will the cost of equity go up as terminal value is potentially valued less in our stocks than today? And so that leads you towards the cost of debt. And green energy bonds potentially could be supportive in maintaining a lower cost of debt. I would tell you largely with big, mid to large cap firms and major oil companies, their cost of debt is relatively low today. And so a sustainable linked or a green linked bond really doesn't change that demonstrably. What it does is potentially help small cap companies. The problem with small cap companies is their ESG ratings in general are going to trail their larger cap peers. And that's not completely fair, but frankly, the large cap and mid cap folks have a little more resources to pull at pushing those ESG scores, pushing your ESG efforts, and putting resources to it. So my concern is that the sustainable linked bonds do not necessarily do a lot for the energy, the historical fossil fuel space, because they're still on the balance sheet, and they're still something that is a cost of capital charge that you have to compare to your oil and gas or your fossil fuel investing. So that's the conflict there. There's not a perfect answer, and I think time will tell. Does that help?
Thank you.
Look, I think there is a cost of capital arbitrage, but it's an arbitrage that's structural. It's not particularly linked to whether or not it's wind or solar. But if you've got a 20-year project or a 30-year project with a legitimate counterparty and you project finance it, you're going to get better terms. That doesn't necessarily apply to technologies that aren't evolved. So, if we talk about hydrogen, for example, we don't know what the economics of hydrogen are going to be. We don't know how efficient electrolyzers will be. So that cost of capital arbitrage that applies to a wind farm or a solar farm may not apply to the rest of the energy transition spectrum.
That's a great point.
Well said.
We heard on the last panel, Damien kind of concluded with the importance of a cost on carbon. And we can talk about how that's going to be important in order to drive policy, to drive investment, or to offset the hard-to-abate emissions that are included in net zero or other emission reduction targets. So I thought it would be great for this audience to hear each of your perspectives on the role that carbon offsets can play in the transition, and maybe some of the complexities around scaling up those markets and even the credibility of those markets.
I'll just say one thing about carbon offsets. I kind of feel like that's like robbing a bank and, going to confession.
Yeah.
Punchy.
Well,
Thank
in
you.
light of that, we really can't say anything positive.
Okay, with that, we'll
moving
open it.
on, no,
Yeah, we will open the floor to questions.
I just say, there are technologies, we've talked about them today. I mean, green hydrogen, you need pretty significant carbon pricing support on that. CCUS, you need some significant carbon pricing support on it as well. We need to have more lengthy discussion at the board, the executive management level, as it relates to any kind of carbon policy, pricing policy. There have been pricing constructs laid out by climate leadership on a carbon dividend policy, and that going towards the end consumer. And then carbon, border adjustment as well to keep everybody on level playing field. Those are interesting concepts. And the reason why those potentially work is because they help offset the cost to the end consumer of this transition. And make no bones about it, it is a broadly inflationary transition. There was so many presentations laid out that discuss that today, and even in going to renewable conferences and so forth. Without being said, it's said. And so, we talk about renewable energy credits, and we talk about the equitability of the transition, and we almost need RAPs. Like instead of RECs, we need like a REC, like a renewable energy and equitability certificate, where you're actually wrapping a renewable deal with continuing to allow a natural gas generation plant to be up and running. So much of that levelized cost of electricity in the Lazard report and so forth over the next several years will be related to the longevity of those plants, the baseload plants and so forth. And so that's a real challenge as it relates to it all coming on the back of the consumer. And the LCFS market is a bit of a regressive tax in that regard. People are utilizing that for carbon sequestration. And layering on different mechanisms in terms of offsets and so forth. And so, we continue to think through all those issues and think through the carbon offset market. And we get concerns about Tom's comment in terms of, how it comes across as greenwashing or not as it relates to, our targets for net zero, because we do have pretty strong emissions intensity targets. 75% methane intensity reduction by 2030, 50%, greenhouse gas emission reduction target. But to get the rest of the way, you need other solutions, and carbon offsets potentially could be those. But they also come with some risk of naysayers who say you're asking for forgiveness of your quote unquote sins on that. So. That should not be ascribed in any way to what we do and how we do it. It's unfortunate that it is.
I think in terms of carbon credits, I think the biggest challenge is it going to go from voluntary to mandatory, right? Globally, most of this is all voluntary. And without a very rigid framework, you have problems around verification and quality of credits, right? So something like direct air capture, that's pretty clear. You would imagine that will be a high quality credit. Well, what if you're purchasing nature-based solutions in a forest somewhere, right? This happened in California not too long ago. You're purchased and then the forest burned down. What's the quality of that credit on the front end? How do you put those two together? So verification is big. My last comment if I could, just kind of relates to maybe policy a little bit on top of credits, because we talk about a carbon tax and things that could speed this up. I think, and I'm just speaking myself as a research analyst, I think one of the hardest things to figure out is where U.S. policy and where the administration's policy is ultimately trying to get, right? And that may sound like a bizarre sentence, but there's lots of discussion on sort of long-term goals about decarbonizing the economy, and this is where we want to get. But then there are all these short-term actions, whether they be around pipelines or whether they be around FERC messaging, that just create like a lot of confusion. Lease sale 257 was another big one in the Gulf of Mexico that got pulled back, but the winning company was actually, it appears, wanting those leases to do carbon sequestration. So there's all this short-term noise that's at odds often with the longer-term message. And I think until there's some sense of stability with that message, all these other things that need to happen underneath that regulatory environment probably won't happen.
Are there any questions from the audience?
Oh, perfect.
Okay.
Okay. And as we move into Q&A, we've got about 15 to 20 minutes left with this panel. I will throw out there that the bar is open. And so,
We're done.
so that there's not a mass exodus.
Why would you say that?
No
But-
questions.
I'm trying to mitigate the line that might be. So if you want to grab a drink and come back in slowly, that might help as we're going through the Q&A. But anyway, questions from the crowd. Larry, I saw your hand up here.
Just have a question. It seems like more and more we're having blackouts with the grid as time goes on. And as we go to this electrification and green energies, is our grid going to be able to handle it? I mean, as I understand, it was originally local grid systems were set up. And I'm just wondering, from a security issue, are we going to have to throw massive amounts of capital to restructure the grid?
Well, there's a lot in there.
There is a lot.
My personal opinion is we need a new grid. The parts of the grid are over 100 years old. And that's just, that's not right. That's a different issue, though, than having blackouts with the present system, which, we can't really blame on solar or wind because we had failures in the thermal systems as well, if you're talking about 2021. We had failures of one nuclear plant, a number of coal-fired plants and natural gas plants, and, it was at night, so solar wasn't there, and wind also was a disaster. But every part of the system failed.
I think in brief, a couple of things just based on our own experience. In order to get interconnections into the grid, ERCOT's one of the most efficient places by which to get interconnections, and they still take several years in many instances. And the reason is because you have to understand the resiliency of the grid as you're adding major renewable investments associated with it. That's in arguably a smaller, concentrated, grid that's completely confined within the state. Elsewhere, you don't have that same circumstance, and you talk about the age and the variability of age across various states in terms of the way in which they've progressed that, the way in which they built it out, the standards associated with it, and then obviously the transmission to move things around. ERCOT, to their credit, really got in front of the west to east transmission years ago, and still we have major congestion issues, and it factors dearly into your price to a company like Pioneer or even the end consumer in terms of potential congestion going west to east and the pricing and how the pricing will play out over an extended period of time. So it's a real challenge, and it's a real challenge for anybody who's buying meaningful amounts of power like Pioneer.
I'm no person to talk about the grid, but I will make a comment on just power demand. And it's just an observation. I was actually talking with Dwayne about it at lunch, and I'm hopeful as a researcher that the dialogue around, and maybe it's happening, I just don't see it as an upstream guy, but I'm hopeful that the dialogue around demand really picks up, and maybe that's a topic for next year, Ann. You know, and I have this memory in my head, right? So if I go, and it's just an anecdote, if I go over to London on business, you know, I'm given one hotel key, and there's a little slot in my room. And if the key is not in that slot, nothing works, right? Completely different story here if I travel to Houston, right? So if I'm not in the room in London, power consumption is basically zero, right? A hotel room in Houston, for basically $1 switch that's missing in the room, I could leave for the day, I could turn the air down to 65, leave the TV on, leave the fan on, open the door of the fridge and all this stuff, and there's no sort of consequence for something that's just a simple switch, you know? So, and I'm just talking ad hoc here, like a lot of conversation around demand and habits is focused around, well, how would it impact my lifestyle? And I'm optimistic that the conversation moves around, how can I just reduce waste? How can I just reduce power waste? And I hope that the conversation moves that way pretty quick.
Yeah, so the EU, right, came out with the 10-point plan to reduce its reliance on Russian gas, and then they followed it up with, or the EU, the Commission came out with that, which followed the IEA's recommendations, and then the IEA followed that up again with an oil plan to reduce its reliance. And 80% of the demand reduction was just behavioral. So things like a slot in the key, which we all need to get Rob to stay at the TCU Hyatt, because that functionality is present there.
Yes, that is great.
And that is where our panelists are staying.
Yes, good.
Other question?
More of that.
Anything else? Yeah.
So there was a famous, I guess, sort of famous podcast that came out a few weeks ago. There was a CEO of a company that came out and said, if we're going to need to increase our crude production, we'll have to ask our investors. I'm sure you may be aware of it. I don't know. But do you really think that's what it comes to? If CEOs are going to have to ask their investors for permission to increase production, and on top of that, is that partially why you're seeing crude production numbers staying stagnant within the past 1 to 2 months? They're sitting at around 11.5 million barrels a day, but does that have to do with investors not willing to fund the additional production from these producers, or is there another reason behind that?
I'm just going to comment from a board perspective and a governance perspective. You know, the way governance is set up on public company boards is the authority to run the company is vested in management. And the board supervises management, and the investors elect the board. So when I get asked those questions, it's like, you know, should we pay attention to ESG? Well, if you change the word investor to owner, I think you have your answer. You know, if the owners want me to pay attention to ESG, I'm going to pay attention to ESG. If the owners want me to increase production, I'll increase production. And that's the way you have to look at it. We're as directors, we're just fiduciaries on behalf of the owners of the company. And so if that's what they want, that's what they want. And if they, you know, sometimes you have a very concentrated group of owners. BlackRock in a couple of my companies is the largest owner. We know how they feel about, you know, hydrocarbons in general, about, you know, paying attention to ESG and you know, publishing good sustainability data. So just from a governance point of view, I think that's, you know, that's good behavior.
From a simple numbers exercise, and I say simple, that's probably not the wrong way to frame it. There's a huge difference in free cash flow for title companies when you move from $75 to $100 a barrel, right? So a lot of this is going to be dependent on how high or how long prices stay, if they do, where they're at. So, and let me give you just a real world example of that. So if EOG is a good example, right? And don't quote these numbers because I don't have them in front of me, but we ran an exercise a couple weeks ago looking at that incremental free cash flow between 75 and 100. If they kept their budget the same, if we factored in OFS inflation, if we kind of set the yield in a pretty decent range, not falling too low, that excess wedge of cash flow where the healthiest companies can go, well, what do we do with this, right? In some cases, it's more than their capital budget this year, right? So to say that the title business model is levered to oil price is a bit of an understatement when you're in a $75 to $100 price range. I'll stop there because Chris will know it from the inside much better than me, but it's a huge amount of cash. So the idea of, could they afford to spend more and still take care of shareholders? Absolutely.
I liked what both said. I like what Mr. Bates said in particular. I mean, I don't know which CEO you're talking about, but I would presume that CEO would likely be talking. When you have discussions with shareholders, those are lengthy discussions, and they happen on regular intervals, especially with prominent ones. And it's a two-way discussion. It's not a one-way discussion, a command-based discussion. It's a dialogue. And so you're discussing with shareholders the broader context of the company, the broader ability for the company to execute on a plan. That plan usually is more than a single-year plan. It's a 3 to 5 year plan, or hopefully a longer plan than that if you have the inventory duration to see it through. And then you're talking about their relative investments. Anymore, some of those investors have alternatives outside the oil and gas space. They're not just energy-specific investors. So, I mean, we as a company are trying to win back value-based investors that have not participated in the space. And so in order to do that and win that construct, you have to win on a number of different areas. Relative reinvestment rate to other industries, where multiples are, the longevity and duration of those returns, the confidence and the variability or the beta tied to those respective returns, and return on capital employed. And so they're looking cross-industry. And so hopefully that CEO's having a dialogue with those investors and saying, here's all the things that we're seeing. Here's how the business matches up. Here's the challenges associated with growing at a much faster rate. Here are the trade-offs with that. Here are the inflationary ties tied to that. So all those things are going into that discussion. And, we're the biggest producer in the Permian Basin, and we're the biggest operator in the Permian Basin. And to stretch materially in terms of our growth rate in the near term would be a stretch. There are areas of the supply chain that were impacted prior to the Ukraine deal, that are impacted post-Ukraine deal, that are tough even if you want to progress the energy security and change that balance of power back in terms of an export realm. I think the Permian producers would be really challenged in that regard in the near term to make material gains. So I think all that probably would go into that CEO's thought process.
Just to provide an investor's perspective here for a second, we've basically had a decade characterized by investing at wrong points in the cycle. And so it's created this feedback loop of slamming on the brakes and then seeing a price response to that, and then overcapitalizing and oversupplying the market, and then funneling that right back into restricting investment and slamming back on the brakes. And it's played a havoc on capital efficiency, on teams, talent, to Tom's earlier point. And so what that's also done is driven a lot of volatility, not only in the commodity price, but also in equities. And we recently issued a white paper, it's available on our website, that examines the volatility and how it's kept investors at bay, because you've basically had a significant amount of 5% drawdowns in oil and gas equities, and that's enough to just keep your run-of-the-mill investor away, not to mention your bespoke energy investors. And so what we would look for in order to encourage investment back into the space would be a durability around that price signal. And that's what we just don't have clarity on yet. You can always look at the curve, but the curve tells you one thing, that the price that you think it's going to be is probably not what it's going to be. And so that's why you have more barrel counters than price forecasters.
It's a good question, by the way.
Yeah, it is a
You
very
could
good
tell
question.
we really didn't have any material thoughts on the matter.
That's exactly right. But anyways, the curve is just now starting to move at the back end of it. And so I think if we had more durability around that price signal, then there'd be a greater incentive for folks to invest where they can. Right now, to Chris's point, it's still very difficult.
Do you think that we should be financing energy security over finding a better way to combat our carbon footprint, finding a reliable source? Where do you think that our priorities should be at this point?
Yeah, I would borrow that answer from you if I could, Megan, about them not being mutually exclusive. When you talked about energy security, my head flipped to, are there fiscal tools that the government can use? I don't know if that was a derivative of your question or not, but I do think sometimes myself about this disconnect between, we talk about trillions of dollars of capital and it's available, or it's seemingly available at the macro, but then at the micro, when we're talking about heat pumps or it's $60,000 for a Tesla, like solar panels on my roof, they sound great, but they're really expensive. It just feels like there's a gap between the micro and the macro, and I wonder if there's something the government could do if they chose to, kind of more on the micro level.
I just note that I don't think they're mutually exclusive in some instances, but in others, they are. I mean, we've talked through where critical and rare earth minerals are largely located. IEA came out last year and had a pretty substantial report saying the same thing. I will tell you, planes and tanks and other things are not running on electricity today. And so as it relates to if it is security, in-country defense security, today there's not a great option in that regard. That being said, that's not a huge draw on resources today or hopefully ever in the future. But I think energy security is oftentimes based on your resources available to run your country without being heavily reliant on others. I think oil has been a remarkable trade because it's a trade in U.S. dollars. It's created a lot of U.S. security in terms of just monetary policy and maintain that security as it relates to monetary policy. So all those things kind of go into that trade-off. I don't think they're mutually exclusive, but in a lot of areas they can be. And it's a really difficult question to ask, and it's a pertinent one in this current environment because it is a global economy. Gas has obviously moved into the global realm where it wasn't before. Oil's been there for a long time. And at the end of the day, if somebody is pulling the plug in terms of that global presence, do you want the U.S. to still have a strong presence in both? And I think the answer is yes.
I think part of the answer may also show up in, it may be a regional answer, but if you ask Europeans today, I think they're going to say energy security. And I think even before the invasion of Ukraine, that was what happened when they changed the taxonomy in January of 2022. They put gas back in and they put nukes back in. And so I think that was effectively a statement that, when we flip the light switch on, the lights better go on. And so I think the Europeans have answered that definitively, that they want security of supply.
Good point.
There needs to be a bit of an alignment on pace as well. So I learned this not too long ago. If you start to search about offshore wind leases, right? Start to read about these in the UK, right? Sky high prices. If you talk to some of the developers, they'll say, well, it's because there's a lot of capital that wants to go in, but the speed at which the government is allowing these leases to be designed and put up for auction is very, very slow. So you get this bottleneck, and then it inflates prices, and that creates bigger problems on the back end because now the project economics are strained. So if you're trying to accomplish two goals that are similar, there's an idea that they have to move at the same pace. I think maybe in that example.
I had a question. As I listen to these presentations, one thing that I've taken down is capital intensity. So the energy industry was kind of beat up with how much cash they were putting back in and not returning to shareholders. But as we talk about whether it's renewables, which have a high amount of capital needed, or capital not necessarily spent on drilling new wells, but adding different types of devices to get the check marks on ESG and such. All of this is in the backdrop of maybe the loss of that U.S. reserve currency as people change, dollar-denominated barrels, and then also rising interest rates. So if we enter into more of a recessionary period, if you believe the Treasury yield curve indications and such, do you think this will be a temporary blip on this transition? Or if we really encounter hard financial times due to this higher costs and such, we will really rethink the pace of this energy transition?
I'm so glad we're ending on a light question. Start talking about the yield curve, Caleb.
Caleb was our top Neeley scholar the
Yes.
year he graduated, the whole MBA program.
I would just share a comment about some of the remarks that have come out of European politicians post Ukraine. Is that if anything, this is a call on more renewables, right? So I don't think that speed bumps, whether they be recessionary or more expensive capital or whatnot, is going to slow this down. That would be my reaction, leaning on Europe as a bit of a leading indicator.
Yeah, a couple things about energy transition, especially in an inflationary environment. Some of the transition renewables in particular, they use the energy payback period is a much longer duration. It runs longer their lifespan, but it's in some instances, but it's much longer energy duration. So it takes, for instance, takes much more energy up front to support renewables, and that takes several years to pay that back. So when you're moving quickly up the development scale and adding substantially, let's say you're moving from 900 billion of total energy spend to 1.8 trillion, and renewables are such a big part of that. Thunderset did an analysis on this, and frankly, stealing from them. I think he does great work. And so it takes a lot of energy to create that energy. So dependent upon the rate at which you're doing that, especially with renewables, if you're scaling that at a much faster rate today to get to 40% penetration or something along those lines, it can be very impactful in a broadly inflationary environment. So that's kind of point one. Additionally, well, I'll just end on that without having to really get into some of the larger effects of just the pull on critical minerals and rare earth minerals and the substitution effects that we're seeing today. I mean, they're huge today at the current rate. So if you change that rate of quite substantially, and or you overbuild, which is also a challenge in terms of the overbuild and then the support behind it and the cost of the support behind it, it's very inflationary, and it's a concern.
I read an interesting piece, and I'm going to try and paraphrase it, from some of Woodmax Metals folks a couple of weeks ago, that if I'm remembering it right, they kind of argued that at the end of last year, there were concerns about where a lot of the minerals were going to come from for the transition over the next couple of decades. But what this paper argued is, with prices being as high as they are now, and these mines are so capitally intensive up front, right? Is this actually something good on the back end, right? Because it will incentivize new mines to get commissioned. So in a decade or 15 years, we might actually have more supply. So it's probably complicating things. I can't wrap it all together in my head, but I challenge myself to think a decade, 2 decades in the future when you try and play current events out.
So I'll just add a little bit of color from a Lazard report I read on project financing in the wind and solar business. And the model that they used was a 20% equity, 80% debt capital structure. If that's a capital structure that's typical of those projects, then as interest rates go up, that challenges the economics even more. So the answer may be, partially in the capital structure. I also think, part of the, the inflationary effects in minerals will impact, some of the projects, some of the renewable projects more than an oil and gas project.
Well, I think today we've heard the words regressive and tax and expensive, and we don't have the technology, and it's going to need to happen faster than we can make it happen, and there's more volatility. So the good news for today, though, is that the bar is open. So we'll leave it.